You have questions, we have answers. This is Jane Muller.
And this is Ken Muller. Welcome to our show, all about real estate with Ken and Jane. Well, it's New Year's Eve.
That's why we're red.
That's why you got me there. Yeah. So first and foremost, we want to wish our listeners a very happy, healthy New Year and make sure it's a safe one.
That's right. And if you think you're going to go party, drink, I wouldn't say get drunk, but if you think you're going to enjoy yourself, please make sure you get a Uber ready on the way back.
Or have a DD, designated driver, for sure.
Yeah,
right?
That's right.
That's right.
I used to be one of them. Yes,
absolutely. Well, we're going to take a look back down memory lane now that 2023 has come to an end. It was an interesting year. I think it was a lot, from the economy standpoint, it was a lot better than expected. And let's talk about Chairman Powell's speech, most recent speech of December 13th, and then we're going to tie that into the real estate market for 2023. So the Fed's speech had actually, even Chairman Powell conceded that we had a very strong year. Yeah. Most of the forecasters, both from the federal and private economists, had forecasted that 2023 would be a recession. That did not happen, which is very good news. He mentioned that the Fed is still committed to getting the inflation down to the 2% level. So we still have some work to do, but we're seeing encouraging signs that it's headed in that direction. There was no additional rate hikes. So the rate right now, the Fed's lending rate is between 5.25% to 5.5%. They gave us a break because if you compare 2022 and 2023, the Fed raised their rates a total of 11 times.
11 times.
7 in 2022 and 4 times in 2023. So I think they said 11 is enough for the time being.
Lucky 11, right? Yeah, lucky number.
The future rate hikes, they left the door open. In the Q&A, they tried to ask him, if this was an indication that there would be no future rate hikes. He said, no, you can never say never, but they always have to look at all the data based on the totality of the data that comes in, and they reserve the right to do it. But he said it was encouraging. But again, their main goals are maximum employment and price stability, and they feel that the inflation is still too high. And he mentioned he gave a chart or said that they want to get the inflation down. Their goal is by 2026 to have it at 2%.
You know what, Ken? I mean, the inflation part, right? As a woman, I already feel it. Why? The supermarket, my favorite thing, right? When you go shopping, and at one stage you can see the milk went up. So now at least the egg went back to, the very reasonable price. And I can see meat section, the chicken and the pork price went down, especially pork price. The beef is still a little bit higher than I liked it, but that's okay. You don't like beef so much. Yeah. So only I eat beef. So so that's okay. So I can feel, when you go shopping, the thing's more reasonable. You can see a lot of discounts, the furniture, everything else. So it's heading to the right direction. But we are, very glad to learn at least, once again, a lot of people mention about next year, the interest rate may go down in start March and April, but nobody knows, as you said, right, that we're still a few months ahead, but at least no more increase is, sounds like a very certain no more increase, which is a good news to stabilize the market, which is very encouraging because every time when the rate hike, they definitely affect the market very negatively. So, which is good. A few months ago, I remembered the rate went up to, 8. So if you buy a condo over 8, I almost cried. So,
right. That's true.
So but now, obviously it's much better. Yes.
Right.
Good news.
And he also commented on that the inflation in the Q&A. He mentioned that the inflation that we experienced due to the past pandemic was not the classic type. And he went on to say that there was a very strong demand plus strong supply chain shortage, both on the limits of the goods and limits of the workers. So he considered that an unusual circumstance.
I mean, once again, we are real estate agent. We are not in the financial or the economics or any type, right? But I think when the government tried to, print money to help the economy, so there's a lot of free cash floating around. So that would definitely create a lot of demand. Right? I mean, you can see the restaurant, right? It'd never be empty. So they always have to wait for your seat. So when that happened, when people start spending because they got money, they spend. And that would create a shortage of the worker.
Right. And
because, the demand is increased. So they need, and that's really,
that's exactly what the data is showing. What he did indicate is that there's still a supply shortage of workers. The demand exceeds the labor supply. And we experience that in the local economy and on the micro level. So that's indicative of what's going on the macro level.
Yeah. And also, I mean, I don't know if it's truth or not. I heard some people talking about, especially during the COVID time, they can get a government, assistance. I mean, work out better to stay rather than go to Manhattan, because you take about the toll, the travel, and it's really a big, not much big difference. So that's all come to the end. Now there's no more money handed out. So hopefully the economy was going back to the regular. There's never be a regular, right? But go back more sort of like a regular time. Yeah.
Meaning pre-pandemic.
Pre-pandemic,
Pandemic would be the.
Yeah. That's right.
That's right. All right. So now we can switch focus to the real estate, which we know better than the.
That's right. In the
economy, which in the inflation and all the PCE and the core inflation and all that.
Oh my
stuff.
God! You remind me about my college.
Yeah, I could put you on a quiz, but I don't want to guess.
Oh, I don't think so. Even though I was a student in college, but I don't think I remember.
Short-term memory, it went in and out, right?
Yeah, that's right. That's like our daughter asked me, "Mommy, what do you know?" The only thing I know is the home price.
Yeah, that is honestly what you say at home.
That's right.
Somebody asks you a question outside of the real estate, you say about calculus, could be chemistry. It could
no.
Not anything. You just say, I don't know anything except the value of your house.
That's correct. Yes, that's what people ask me. For they don't add. I can't be their tutor because no hope there.
Unless it was a real estate related class, which I don't think they have in high school yet. They have
they should.
I
think they should. Yeah.
Well,
they should have some.
At least investment, and then real estate goes hand in hand with investment. So
that's right.
Be a good combination.
I did offer my service to East Brunswick High School. I think they can't hire me because I'm not a qualified teacher. Yeah, but I think that would be good to have something like that, in a high school. Yeah. You never know. Some kids may be interested to doing it as a career.
Yeah, well, they do have the career day where I think parents can volunteer. I think you also volunteer to come in and talk about your career. Some teachers have that to give insight into.
Which is really good. Very good for the kids, yes.
Yeah. All right, now we're turning to your favorite topic, which is the data, right?
Yours, not mine. Yeah.
All right, so the first category we're going to look at is in the past 3 years, the number of active listings as published by the CJ MLS, Central Jersey MLS. So starting with 2021, there was a little bit more than 46,000 active listings for the year of 2021. Yes. Okay. And then in 2022, it decreased to 38,000 active listings. So there was a downward trend. And then it further decreased in 2023 to approximately 27,000 listings. Yeah. So if you do the comparison percentage-wise, it went down from 2022 as compared to 2021. It went down 29%. And then from 2023 all the way compared to 2021, it was about 40% lower. Yeah. So if you compare this year to 2 years ago, it's 40% less listings. Okay, and that's, I think, indicative of what we've been talking about in prior shows. The reason is because the inventory is tight. Why? Because most people have locked in the low interest rates. they're happy and content where they are, and they don't have the incentive to move or the need to move because the interest rates they're very happy with the low interest rates.
I don't know they're content and happy where they are, Ken, but I do agree with you. They it make most sense for them to stay where they are.
That's probably a better way to put it, right?
Yes, that's right. And having listened to these numbers, right, the active listing, that's pretty much in the market too. And talking to other real estate agents, right, across the board, I mean, some people may be high, some people may be low. Average agent production went down is pretty much by that number because we can't sell home if there's no home to be sold. In Chinese, there was an old saying, if there's no rice and even the best cook cannot make a dish out of it, nothing, right? So that's here. We cannot sell a house if there's no home available. So that's pretty much in line. Even our numbers, or even my number, because I represent most sellers, even my number went down. But thank God it wasn't that much, but still, last year, this year compared with 2021, which is the highest year, it's about 20-some% down. Yeah, which is better than 40%.
So you beat the market. You outperform
the market.
You outperform the market. Which
is sometimes when your number is down, you can be beat down yourself and say why. But on the other hand, if you look at the market, actually, you should feel pretty grateful and happy. So that's really, I mean, once again, a certain market is better, more availability than the other. So that's really the number is the Central Jersey. It's the entire Central Jersey number. So some township, some pocket may have even less inventory, very less inventory. Some may have slightly more. So that's the average. That's definitely active listing. It's become a very, very tight for 2023. That's the theme in 2023. Very, very tight inventory. Yes.
Okay, that's the inventory. Now, the number second, we're going to talk about the number of sold transactions, number of units that sold. And we're going to start with 2019, which is the pre-pandemic year. There was about over 17,000 units sold in 2019, and that went down. That dropped in 2020. Again, that was the start of COVID to 11,000, which is, again, the pandemic started in March of 2020. And then in 2021, it increased by 11% to 12,000 some units. And then 2022, it went down 10,000, which is 15% lower than 2021. And then in our current year, 2023, we dropped to 7,000 units sold. So that was a 30% down as compared to 2022.
Yeah, so, that closed one. We don't have a 2023 number yet because the year end today. So we won't get into first week, second week in January because they always have a last time adjustment. The people closed, not done in system. So the number will be in 2 weeks later. But just by judging off the availability in the active listing, we can see this year definitely, conservatively, I think is around 20% lower than last year home sold. Once again, it's not bad market. It's not no buyer there, so don't worry. It's not the market going down. No, it's not real estate going down, not market going down. It's purely because the availability.
Right. I think it coincides with the active listings. Of course, if there's 40% less active listings comparatively, then it's natural to expect there'd be 30% lower.
Yeah, maybe more because the close not counting on 2023
right.
this year.
So the numbers, make sense. The data makes sense. Mm-hmm. All right, why don't we take a short break? We'll be right back after these messages. Okay, welcome back to our show. So we're going down memory lane, reviewing the data for 2023. We covered the active listings. We covered the number of units that sold. And anything else you want to say about that before we move on to the category number 3, which is the median pricing?
No, I think all top 3 are good to know. I think our audience want to hear the third one. Yeah, show me the money, right?
Right, show me the money. Okay, well that's the median price, which is what the data that's published by the CJMLS. For this one, we went back from 2013.
Give it 10 years.
Give us a 10-year history. So from 2013 2013 as compared to 2014, the median price went up 2%. From 2014 to 2015, it went up 3%. And then it went up again from 2015 to 2016, it went up 2%. Then again, 2017, 4% up. 2018, increased 6%. 2019, 5%. And then with the start of the pandemic in 2020, the median price went up a total of 10%. That's when we started getting those escalations in 1 year, 10%.
Yeah. You know, in average...
Even our producer is shaking his head saying, yeah, that's
that's crazy. But think about it, right? In the average market, right, before the pandemic, it's a lifetime, really. I mean, pretty much 2 to 5% average.
Yeah, that's what the history has been
year
showing.
After year, yeah.
And if you think that one was big, Tom, I'll tell you what, I can top that in 2021. Not only did we go up 10%, we went up 15%. So that was, again, that was the year after COVID. But I guess if my memory serves me correctly, we were still in COVID protocols, or we were starting to get the vaccinations.
Yeah.
But people were still, the interest rates were artificially suppressed so low. And so actually 2021 was more of a bang year than 2020 at 15%.
Absolutely. Because think about it, 2020, right? I mean, January, February, in general,
there was nothing.
That was quiet because before pandemic, normally the January, February, most people put a house, roughly around March. Yeah. But in March, we had a shutdown until June. May and June. And then June started and people still wear the mask, didn't know where to go. So there was a very, just mainly to digest the home on the market carried from 2019 and early 2020. But only after August, September, when people realized the market went up, a lot of people just put a house on the market. So that's in the year 2020, we have to see as like a 6 months kind of the effort, right? So that's why even though they went up, didn't went up that much, but 2021 went up 15% because that's actually the 4 year after pandemic hit the effect the whole year. Because 2020 it started March, but it was a shutdown until May. So basically 6 months is gone.
And you'll never forget, though, during 2020, that summer, those long lines.
Yeah.
It was like record long lines. It was like they were giving away houses. People were waiting. I felt so bad for some people because it was so hot. It was hot in the summertime. And people were waiting sometimes a half hour or longer. I think you were even giving out waters to some of the people online to the open houses because they were.
There was like one day I remember there was an agent call me up, say, Jane, you better come here because the family they only allowed 15 minutes because you can't have more than one family that time, still shut down during the shutdown. So the long line from the house to the end of the street, the cars everywhere, and some families stay longer. So than 15 minutes. So the long line was that long. The agent called me up, said, Jane, you better come here. So I have to rush there, direct people. Quickly showed me around and said, you want to talk in the backyard, talk in the front yard. Yeah. So it's really that was really, hard time.
And it was rough on the agents too, because everyone had to wear masks. So if you're out showing or if you're hosting an open house, you're wearing the mask from
Not only that, Ken, I'm really, my heart goes to most sellers when they still live there. You think your life is hard as a buyer or as an agent after you guys left 4:30, 5 o'clock because open house normally till 4, but people hang till 5:30. After we finished, the owner have to send one representative home to wear mask, wear gloves, and desensitize the whole house before the rest of the crew move in. I did have a few clients even stay away. So I get a key Friday, lunchtime. We'll have an open house Friday, Saturday, Sunday. So what it did was the owner, they will leave in the Friday after lunch. They left. They check in themselves in a hotel somewhere. Yeah. So they come back late Sunday night. So once again, they send one family member back to do the thorough, cleaning, and not the cleaning, but just, wipe out all the surface. And before the kids, they came back. So that time was really, that was like, never forget. That was a
Right. And
lifetime experience.
We tried our best, as a lot of agents did, to try to minimize that by having the sanitizer.
Sanitizer,
there
yeah. We had the
requiring people
sanitizer.
to, wipe their hands and trying to also
Yeah.
open all the doors for the
Yeah,
closets,
for them.
the restrooms,
Yeah.
so there would be the limit that make it as touchless an experience
Yeah,
as possible.
yeah.
But still, they had to, they were still over concerned because of the unknown certainty about
Yes.
the virus and its effects, long-term effects and health
That's
effects
right.
on people. So
We'll wear gloves,
taking
we'll wear a
precautions.
mask. Yeah, absolutely. Yes.
Yeah. So then, so now getting back to the numbers, which is really
That's your
which is
specialty.
but we're dry. That's why I have to throw in a little bit of these storylines. So then 2022, obviously, so 2020, 10%, 2021, 15%, 2022, we came back down to the pre-pandemic levels of 5% increase.
Yeah.
And then this year, again, everybody said that, a lot of predictions were we'd hit a recession. Actually, the median value went up 2%.
Yeah, which is not bad. I mean, 2 to 5% is average. It's all these history
Years.
shows, right?
Right.
So that's in a way. We went back to the norm, even though there's no such thing. What is norm? But we somehow, went back to the old pattern, 2 to 5%. But having said that, 2 to 5% is still high because it's over last year. So in fact, if you compare 2023 and 2019, and that was the whopping 35%
You're up 35%
over.
for those 4 years, which is amazing. 35%, the median home value from 2019. But if you look, interestingly enough, if you look at 2013 through 2023, every year the minimum median value went up at least 2%.
Yeah.
The trend has been up every year, which is pretty amazing.
But once again, Ken, that's average.
That's average.
I mean, if you bought a house 2006 or 7 on the high, you may not get 35. You may get 25, 20, what not. You at least get your money back. At least you can get out with a little profit. But we did have some of our own client, right, bought just before the COVID or just at the COVID, right? They all got out huge. They didn't have a 35. They had a 40, 50% increase. If they bought it right, they almost, 50% up. So that's really, that's this market. I had a lot of people bought 2019 or 2020. Now they when
so they
sell.
bought 2019. They really hit.
They
are
hit the
riding
low.
on the wave because the title of the wave just went up, and then they have to before it crashes. That's
a lot of people want to cash in. So So, but a lot of people not enough to change the inventory issue in the market. Yes.
Right. All right, so
that's what happened last year.
That's so interesting.
Forward.
Moving forward, but it's like even like Chairman Powell said that predictions are only predictions. Just like at the beginning, like a year ago at this time, everyone was so uncertain about 2023 and thinking that we're going to hit a recession or it's very likely, or we're going to have a mini recession, or it's everything looked doom and gloom. And so nobody expected it. So with all the data and all the fancy economic formulas, it's sometimes the market is just unpredictable. And that can be good.
Ken, I always heard
you can almost
story.
throw darts just like the stocks, right?
They said the 2 jobs, right? You get you get paid well by your wrong. One's a forecast, right?
You smile.
If you say it's got a big storm, didn't have it, I don't hear people screaming and yell at you. People say, "Thank God."
Yeah,
they
just
hear
like the
our
economists,
prayer.
nobody's criticizing
That's exactly.
them for saying, you're wrong. They're happy they're wrong.
That's the 2 jobs people, have no issue if you're wrong. So
that's true. Yeah. So do you want to take a crack at what we can expect possibly for 2024?
I already had a lot of clients reach out to me, say, Jane, now we heard interest rate going to go down next year, March forward. So what do you think about the economy? What do you think about the housing price? Should I wait? Should I do this and that? My take is, first of all, we don't know the interest is going to go down or not. That's unknown. So we don't know. Secondly, just say if the interest truly going to go down, but why Fed would decrease the interest rate? Because they want to keep the economy going, right? So at the end of the day, the interest rate if the interest rate going down, right, you will create a lot of interest in buyers, right, because interest go down and help them. But on the other hand, if their job, if the economy become weakening and they worry about their job, they may not line up to buy a house at this point, and people may hold on to their pocket money, for the tough time ahead. So nobody knows. Once again, 2024. My advice to the clients and the audience out there is, if you need to sell, sell. Okay? If you need to buy, buy. Do not try to time the market, because when you time the market, most of the cases we're wrong. Okay? If we can be right, I mean, we're all billionaires, we're all retired. Mm-hmm. So sometimes when you time the market, that's tough. If you think you're going to retire a year or two, you want to sell and rent for a year or two, so you have the money ready to buy a house, to decide what your next happening in your life, next chapter, I would say to sell, because inventory is still tight. When the real estate business is supply and demand. When there's a very less supply, your home value will hold up. So if you're thinking you're going to retire, or if you're thinking you want to make a change in your life, that's the time. Same thing. If you want to buy, people this morning, before I got here, people call me and say, should I buy now? Should I wait? I said, well, unless you need it, the market will go down. Just the million-dollar question is when.
Yeah, but I almost think if you look at the last 10 years, the market's gone up, up, up. So if people are in the position to buy, I almost think that buying is a smart decision, because again, unless you time the market and you have some knowledge that none of us have of exactly when the market is going to go down, it's been on a progressively upward trend for the last 10 years with of at least 2% per year.
But Ken, I agree with you, but I disagree with you. No. 2013, the number we go back, it didn't take consideration 2010. 11 and 12.
Oh, right.
So the market always corrects itself, right? If you buy it now, if you hold for long term,
it's going to be
you'll be okay.
Just like with a blue chip stock, if you hold it long term, you may buy it and it may go down, but if you're willing to hold it's going to eventually go up again. So you'll be ahead of the game if you're going to hold it for a long enough period of time.
Just look at 2005, 6, and 7. Yeah. These people, right? Those homeowners, right? They bought on a high. Everybody said, "Oh my God, what am I going to do?" But if they hold it to now, they still make money. They still got out ahead, right? So that's the thing. If you need a house long term, buy it. If you want to sell, need to sell it. But do not. 2024 is not a good year to time the market.
Right. All right. Well said. We're almost out of time. We want to again wish everyone a happy and safe New Year. All the best for 2024. We'll see you next week. Be safe.
Happy, healthy, and enjoying life. Thank you. Happy New Year.